best poker players in the world lose 40% of their hands and still make millions. They've mastered something that 99% of traders never understand: how to make optimal decisions under uncertainty without needing to be right. While you're obsessing over win rates and perfect entries, professional poker players are thinking in terms of expected value, bankroll management, and emotional control. They fold premium hands when the pot odds are wrong. They bluff with garbage when the situation is right. They never go on tilt because their ego isn't attached to individual outcomes. What if you applied this same psychological framework to your trading? What if instead of trying to predict market direction, you focused on making profitable decisions regardless of whether you're right or wrong about price movement? The fold equity mindset. Every poker player learns that folding isn't losing, it's capital preservation. Yet most traders treat cutting a loss like admitting defeat, rather than making a smart business decision. The fold equity mindset teaches you that not every situation deserves your money, and the ability to walk away from unfavorable odds is more valuable than the ability to predict outcomes. When a poker player folds pocket kings because the board texture and betting action suggests they're beaten, they're not being weak. They're being profitable. In trading, fold equity translates to cutting positions that no longer meet your criteria, regardless of how much you've already invested in the trade. If your technical setup breaks down, if the sector rotation shifts against you, if your risk-reward ratio deteriorates, you fold the hand and wait for a better spot. This isn't about being right or wrong about your original analysis. It's about responding to new information without letting sunk cost fallacy trap you in a losing position. The psychological shift happens when you stop viewing stopped-out trades as failures and start viewing them as successful risk management. Poker players celebrate good folds even when they would have won the hand, because they know they made the mathematically correct decision based on available information. Traders who adopt this mindset celebrate cutting losses quickly even when the trade would have eventually worked out, because they protected their capital and preserved their emotional equilibrium. Most traders revenge trade after losses because their ego can't handle being wrong. Poker players learned long ago that ego is the enemy of profit. They fold strong hands when the situation is unfavorable, and they fold weak hands when the pot odds don't justify calling. They never chase losses by playing looser or taking bigger risks. Instead, they tighten up their selection criteria and wait for spots where probability is clearly in their favor. The fold equity mindset also applies to not taking trades in the first place. Poker players fold roughly 80% of the hands they're dealt because most starting hands have negative expected value. Traders should be equally selective, passing on setups that don't meet their criteria rather than forcing trades out of boredom or FOMO. The money you don't lose by folding bad spots is just as valuable as the money you make from good spots. But understanding when to fold is only the beginning of what poker psychology can teach you about trading. The pot odds framework. Poker players never bet based on how they feel about their cards. They bet based on pot odds, implied odds, and expected value calculations that remove emotion from the equation. If the pot is offering 3-to-1 odds and they have a 25% chance of winning, they call regardless of whether they're feeling lucky or scared. This mathematical approach to risk-taking eliminates the psychological errors that destroy most traders when determining position size. The pot odds framework in trading means sizing your positions based on probability and risk-reward ratios, not on confidence levels or recent results. If a setup has a 40% win rate but the average winner is 3 times larger than the average loser, you risk the same amount every time regardless of how sure you feel about the trade. Your position size is determined by your edge and your bankroll, not by your emotions or your need to make back recent losses. Most traders size up when they're confident and size down when they're uncertain, which is exactly backwards from what probability theory suggests. Poker players learned that confidence has zero correlation with actual outcomes. A player might feel great about pocket aces and terrible about a suited connector, but they size their bets based on mathematical expectation, not emotional attachment. The suited connector might actually have better implied odds in certain situations. The psychological benefit of mathematical position sizing is that it removes the internal pressure that comes from having too much at stake. When you're risking appropriate amounts based on your edge and bankroll, you can make decisions based on logic rather than fear. You're not hoping your trade works out because you need it to pay rent. You're not scared to take a loss because it won't materially impact your ability to continue playing the game. Advanced poker players also understand implied odds, which means considering not just the immediate risk, reward, but the potential for future betting rounds. In trading, this translates to considering how a position might scale if it moves in your favor, or how much additional risk you might need to take if the trade requires management. This forward-thinking approach to position sizing helps you avoid situations where you win the battle but lose the war. Once you master mathematical position sizing, you can start thinking about something even more powerful: the tilt control system. Tilt is when your emotions override your rational decision-making process, causing you to make suboptimal plays based on frustration, fear, or overconfidence. Every poker player has experienced tilt, and the best ones have developed systematic approaches to recognize it, stop it, and recover from it. The same psychological framework that keeps poker players calm after bad beats can keep traders disciplined after losing streaks. The first step in tilt control is recognizing your personal tilt triggers before they hijack your decision-making. Maybe you start revenge trading after 3 losses in a row. Maybe you increase your position size after a big win because you feel invincible. Maybe you abandon your strategy after a few breakouts fail because you start doubting your system. Poker players catalog these patterns and build specific protocols to interrupt them before they cause damage. Physical tilt recognition is just as important as mental awareness. Poker players learn to notice when their breathing changes, when their muscles tense up, when they start making faster decisions or taking longer to act. These physical symptoms often precede psychological tilt by several minutes, giving you a window to intervene before you make costly mistakes. Traders can use the same body awareness to catch themselves before they override their rules. The recovery protocol is crucial because everyone will experience some form of tilt eventually. Poker players have predetermined responses when they recognize they're not thinking clearly. Some take a 5-minute break to reset. Others have a mental checklist they run through to refocus on process rather than results. Some have a stop-loss for their emotional state where they quit for the day if they're not operating at full capacity. The key is having the plan in place before you need it. The most advanced tilt control involves reframing losses as tuition payments for market education. Poker players understand that bad beats are part of the game, and that getting upset about variance is like getting angry at gravity. When you can view trading losses the same way, as inevitable costs of doing business rather than personal failures, you eliminate the emotional charge that leads to tilt in the first place. Each loss becomes data about market behavior rather than evidence of your incompetence. The ultimate goal of tilt control isn't to never feel emotions about your trading results. It's to create enough space between the emotional reaction and your behavioral response that you can choose how to act rather than react automatically. When you master this psychological skill, you join the small percentage of traders who get stronger after losses rather than weaker. Comment below and tell me which of these poker psychology principles you need to implement first in your trading. Because the market doesn't care about your emotions, your ego, or your need to be right. But it will reward you generously if you can learn to make optimal decisions under uncertainty, just like the best poker players in the world. Master these psychological frameworks and trading becomes less about predicting the future and more about responding to probability with mathematical precision and emotional control.